and now I want to have a debate because I know that you don't agree with much of what he said.
Respectfully, I do disagree. I mean, next week is definitely make or break. It's either going to confirm this is a rally, or it's going to crush it back into a bear market rally. And right now, it's still in the classic throes of a bear market rally. We're not quite off 10% from the lows on the S&P 500, but all eyes are on next week. I feel like this week was the warm-up week, and then next week we get so much data with all the mega tech reporting. Obviously, you have some concern on what social media may look like with the Snap and the Twitter today, but generally all eyes on the Fed. And I think those two things, both the mega cap tech as well as the Fed, and 175 S&P 500 companies reporting next week are going to either confirm this is a true rally, or it's going to say, no, there's too many macro headwinds, and you're going to see this flip right back around pretty hard. We are definitely concerned. I will freely admit, earnings have not been quite the dumpster fire I thought they were going to be. You know, you've seen them a little bit stronger, but you're seeing so much muddled data. On one hand, you have American Express saying, no, everybody's spending, it's going to be travel, and everybody's spending so much more on travel and leisure, and we've got a good runway there. And then you have Verizon and AT&T saying people aren't paying their phone bills. So you're getting these two different pieces of data, and you have all these macro headwinds, and we talked about them, right? Inflation, dollar, Fed, hawkishness. How do we see these two factors and who wins out? I tend to think the macro factors are too much of a wall to climb, and I tend to think this is still a bear market rally.
Steve, maybe Brian's right. Maybe Jim Lebenthal is right. Maybe those who have called the bottom are right, and that everybody just got too negative. Still got PTSD from '08. Every crisis that comes up is the next '08, and we can't see the forest through the trees, and that the economy is still pretty good to give the Fed some cushion to do what they need to do, and inflation has, in fact, peaked. Well, why is that not right?
I'm going to cast my lot with Victoria here. I think if you take a step back for a second, you know, I keep hearing about sentiment being negative, yet every month ahead of an inflation report, we fool ourselves into thinking it's peak inflation this month, and then it's not. And we still haven't given up on the growth religion here. As I look out, you've got every central bank in the world engaging in the most aggressive synchronized monetary tightening in a generation. You've got unemployment claims that are up roughly 70,000 from the bottom, which is the average increase prior to a recession. You've got credit card spend that's having the greatest 12-month increase on record, just as we're hearing some of the news from AT&T and Verizon. And I think what we're headed for here, you know, the market, I think, is too cute by half. It's playing out 3 steps on the chessboard, Scott. It's saying, okay, inflation today means the Fed's going to be more aggressive, which means the recession comes sooner, which means rate cuts come sooner, so let's buy now. I think what they're missing is this can all take longer. I think rates are going to be higher for longer because if you want to crush this inflation that's entrenched, it's not just about energy. It's about getting wage inflation down, which means unemployment's going to go up. And that's going to take some time to play out. So we prefer to play defense right now. We think this is still very much a bear market rally, and we think that this landing, hard landing, soft landing, we think it's a longer, rocky landing, something that's more like 4 to 6 quarters, not 1 to 2. Be defensive now, get greedy next year is the way we're thinking about it.
So Brian, right, kind of the point is that earnings not quite as bad, labor market still strong, are not equal on the scale next to what's happening from the Fed. The largest amount of tightening in, as Steve said, a generation. Those aren't equal. And what's going to happen from the Fed is likely to push all of the positives too far to the side to be able to keep this rally going.
Well, I think a 4 to 6 quarter forecast in terms of that type of slowdown and that type of bear market / recession. If you go back and look at history, you don't really necessarily see that necessarily. I've been in the business 33 years. I've been through a lot of different recessions. This, to me, is starting to feel more and more like what happened in 1990. And then we had a consumer recession that we snapped back really quickly from. And it was actually a very shallow recession. And the Fed didn't have to act that long. We saw a very big ramp up in unemployment claims the second half of 1990, only to the Fed to come back in and do what it did. And then we had a very, very shallow recession. With respect to the negativity, what was said just in the previous guess is again, what everybody's saying. I like to take the opposite way, not just because I want to, but because I think that investors in general, the last 20 years have become way too macro driven. and they're not looking at bottoms-up fundamentals. And the one thing that I would tell you is that small mid-cap stocks and small mid-cap companies that are privately held companies in the U.S. remain very well positioned, are taking out bank loans, are trying to build their businesses. And that's the backbone of the U.S. economy. We talk about how strong the U.S. consumer is, but small companies are the backbone, and we're still seeing very strong flows in terms of loan growth there.